I'm Mike April, and this is April's Tax Tips. Is incorporation so beneficial over being a sole proprietorship? Well, being a sole proprietor means that every December you need to determine your profits, add it to your existing income, and pay the tax rate that you're at. Then start all over in January again and do it all over for another year. It's especially unreasonable if you have a moderate to high paying income already as an employee somewhere and haven't transitioned to your business full time yet. It could mean that maybe you're paying from 18% to 26% of your profits to tax. I don't know, that's a lot of cash. Anyhow, let's go through some of the incorporation advantages. You can set your year end to whatever suits your business best. And I really like this particular area because if most of the people, especially a sole proprietorship or a partnership, have a December 31st year end, then they're taking it to their accountant in January, February, March, when everyone else is bringing in their personal tax. So guess what? The accountant doesn't get to spend as much time, maybe as he should, on your tax side of things. So having your incorporation set to maybe a March 31st year end, right up to November 30th year end, anywhere in between is a good thing, because usually the accountants are a little bit more relaxed, have more time to review your files, and are usually less prone to make mistakes, really is what it boils down to. Because sometimes I find from that January to March period, a lot of them are really pushing through many clients, and a lot of them are running long hours per day. So anyhow, that's the advantage to being able to set your year end to one of those other months. There's also small business tax credits available, so the tax rate is usually in the low teens. So usually from 9 to 11% tax rate on corporations which are below $500,000 in revenue. So that's another major business advantage. Would you rather pay 9% or 24%? Also, you can choose between receiving either a salary or paying dividends, which has its benefits on the personal side, tax side as well. So that now allows you to make some choices on how you pay yourself, as opposed to on the sole proprietor side, whatever you have as profits automatically gets added to whatever income tax rate you're currently at. The other part is the share structure. Dividends can be split between your shareholders. So it could be your spouse, it could be a spouse or partner, it could be another colleague that you have share the same brain trust with in the business, or maybe one person is more good with the sales and the other person is really good with the business side of things and the operations. So it allows you opportunities to be able to compensate you through a dividends, and also you could pay other investors through dividends as well. So let's say your brother-in-law loans you $10,000 to start your business, you can add him as a shareholder so that he actually can receive share in some of the profits as a shareholder, if that's a route that you choose to take. And then all of those parties get to receive the dividend tax credits too, especially if they're actively involved in the business. It also allows you to operate in a private health spending account or a PHSP. And so there's lots of doors that open by being incorporated. And just to give you an idea, setting up a corporation usually is between, through most lawyers, somewhere between $1,100 to $1,400. It's important also that the articles of incorporation are unique, as the shareholders' shares that they're given can either be voting or non-voting, and will also help in determining the flexibility in keeping your taxes low, because the accountant looks at how the shareholders are classed and what their participation is as in determining how to pay them out with the input from the owners of the corporation. Anyhow, that's just a few tax tips on benefits of being incorporated, and maybe now you have a more informed decision on where to take it next. Take care.